It is 9:30 a.m. on expiry day, and you're up big. You caught that early momentum, your screen is flashing green, and you feel untouchable. But by 3 p.m., every single rupee is gone. You took one bad trade, tried to revenge trade your way back, and wiped out your account. You probably blame the market makers. You blame a sudden algorithmic spike. But the market didn't click the mouse to buy those worthless out-of-the-money options. You did. Your setup isn't failing you. Your psychology is. To stop bleeding capital, you need to fix the person sitting in front of the screen. We are going to install 3 specific psychological constraints that force you to stop reacting like a gambler at a roulette table and start executing with cold precision. Because memorizing candlestick patterns means absolutely nothing if you cannot conquer your own emotional impulses first. Let's start with the first fix: breaking the casino mindset. Most retail options buyers operate under the delusion that trading is a fair 50-50 coin flip. It is not. The system is structurally weighted against you. Every time you enter a trade, you immediately start losing money to hidden frictions. High brokerage fees, heavy securities transaction taxes, and relentless premium decay silently drain your account. A manageable loss of 5,000 rupees quickly bloats into a 6,000 rupee hole, simply because you have to pay to play. When you step into the domestic markets, you are stepping into a massive institutional arena where high fees and low leverage act as a built-in house edge. The odds are stacked deliberately to punish impulsive trading. To survive this, you must implement a strict daily trade limit. If you restrict yourself to exactly 2 trades a day, you artificially cut off the ability to revenge trade. Once those 2 bullets are fired, you close the laptop and walk away. A professional trader knows their primary job is not to chase daily profits. Their job is to ruthlessly defend their capital until the market hands them a mathematical edge they cannot ignore. This chart shows the second trap: over-knowledge. Terrified beginners try to buy a false sense of security by cluttering their screens with lagging indicators. Moving averages, relative strength index bands, and chaotic trend lines pile up until you can't even read the actual price. Institutional algorithms ignore your perfectly drawn triangle patterns. They are hunting for one thing: liquidity. They track the exact zones where thousands of retail traders have predictably placed their stop-loss orders. This plays out every single day on highly traded retail indices like the Nifty 50, which act as the perfect battlefield for these engineered traps. Look at this clean price action chart. Notice what happens when a widely watched support line breaks. Retail traders instantly panic, aggressively buying puts. They are willingly offering up capital. The moment enough retail money is trapped, institutions violently reverse the price. A massive green candle sweeps upward, hunting every single stop-loss sitting above that broken support. True market vision means ignoring geometric shapes. You must develop the discipline to sit on your hands, wait for the trap to spring, and trade in the direction of the trapped money. Which brings us to the third fix. You spend 40 hours a week at a job, enduring an angry boss just to save a fraction of your paycheck. Yet you will take those hard-earned savings and blindly risk it in the live markets, without testing your strategy. It is exactly like driving a high-performance sports car on a wet highway with a blindfold on. The defense against this recklessness is rigorous backtesting. You take your specific setup and run it across 1 full year of historical data. You document every trade to identify exactly which days of the week and which specific hours of the day cause your strategy to fail. This leads to your final rule: do not deploy a single real rupee until your back-tested data proves an 80% win rate. Live markets introduce variable factors and raw emotion, meaning that 80% quickly drops to 60% when real money is on the line. Trading blindly on a feeling is a symptom of emotional impatience. Doing the tedious work to prove your edge mathematically shows you have finally reached psychological maturity. If your trading is exciting, you are doing it wrong. True, profitable trading is devoid of thrills. It is the boring, repetitive execution of a proven system, day after day. It is time to confront your ego. Drop down into the comments right now and type out the largest loss you've ever taken from revenge trading. Make it public. Accept the mistake so you can finally let it go. Then abandon the casino mentality for good. Hit subscribe to join a community focused entirely on systems-based survival and mathematical edges. Stop giving your money away to the institutions. Stop acting like an emotional gambler and start executing like a cold,